Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today we're taking a thrilling journey into the realm of home ownership. It's an exciting milestone filled with anticipation, but it's also a path that requires careful navigation. We're here to guide you through the intricacies of purchasing your first home, from understanding the underwriting process to demystifying loan types and beyond. So, buckle up and get ready for a thrilling ride. Stay tuned as we delve into the nitty-gritty of becoming a first-time home buyer. Proverbs 24:3-4 says, "By wisdom a house is built, and through understanding it is established. Through knowledge its rooms are filled with rare and beautiful treasures." In this journey of home ownership, the wisdom lies in preparing thoroughly. First things first, gather all the necessary documents. This isn't just a formality, it's a crucial step on your journey. Among the documents you'll need are proof of income, which can be your pay stubs or W-2 forms, and your credit history. Your credit history paints of your financial responsibility and trustworthiness. Don't forget your tax returns, typically for the last 2 years. These provide a more comprehensive view of your annual income. Lastly, you'll need a form of identification, like a driver's license or passport. This verifies your identity and ensures you are who you claim to be. Each document plays a vital role, serving as pieces of a larger puzzle that helps lenders assess your eligibility for a mortgage. Remember, incorrect or incomplete documents can delay the process, so be thorough. This is your first step towards owning your dream home, and every detail counts. Now, on to the underwriting process, a crucial step in securing your home loan. The underwriting process is the gatekeeper to your dream home. It's where your financial life goes under the microscope so that lenders can assess your risk level. See, underwriters are like detectives. They scrutinize your financial situation, examining your credit score, your income stability, and your overall financial health. They're the ones who check if you're eligible for the loan you're applying for and determine the conditions of that loan. Think of your credit score as your financial report card. It's a reflection of how well you've managed your debts and payments in the past. A high score can open doors to better loan conditions, lower interest rates, and a smoother underwriting process. Your income stability is equally important. Underwriters need to know that you have a steady source of income to meet your mortgage payments. They'll look at your employment history, your salary, and any other income sources. The underwriting process is thorough, to say the least. It's all about ensuring you can handle the financial responsibility of home ownership. Yes, it might feel invasive, and yes, it can be stressful. But remember, it's all designed to protect you from biting off more than you can chew. So, keep your financial house in order, maintain a good credit score, and show that steady income. The underwriting process may seem daunting, but it's a necessary step to ensure you're ready for home ownership. Understanding the different types of loans can help you make the best choice for your situation. First, let's talk about conventional loans. Loans. These are mortgage loans offered by private lenders without any government insurance. They can be more challenging to qualify for, but they often come with lower interest rates and fewer restrictions. The typical down payment required for conventional loans is usually 5-20% of the home's price. Next, we need to discuss primary mortgage insurance, or PMI. PMI consists of 12 months of property insurance, property tax, and school tax payments held in the bank's escrow account, and added to your monthly principal and interest payments. It's essentially an insurance policy that protects the lender in case you default on your mortgage payments. This extra insurance is often a requirement when your down payment is less than 20% of the home's price. Moving on, we have government-backed loans. These loans are insured by the government and are typically easier to qualify for. They include FHA loans, which usually require as low as a 3.5% down payment. VA loans for veterans and active service members, which often don't require any down payment, and USDA loans for rural and suburban homebuyers, which require a 3.5% down payment. Now, let's talk about fixed-rate mortgages. These loans have an interest rate that stays the same for the entire term of the loan. This means your monthly payments will be consistent, making it easier to budget for your mortgage payment every month. On the other hand, we have adjustable rate mortgages, or ARMs. These loans have interest rates that can change over time, usually after an initial fixed rate period. ARMs can be a good choice if you plan to sell or refinance your home before the rate changes. Lastly, let's discuss loan to value, or LTV. This is a ratio that compares the amount of your loan to the value of your home. It's used by lenders to assess the risk of the loan. A lower LTV means you have more equity in your home, which can make you an attractive borrower. Now, let's clear up a common confusion point: the difference between the mortgage interest rate and the annual percentage rate, APR. The mortgage interest rate is simply the cost of borrowing the principal loan amount, whereas the APR includes the rate plus other costs, such as broker fees, discount points, and some closing costs. It's usually higher than the interest rate and is a more accurate reflection of the total cost of the loan. Remember, each of these loan types has its advantages and disadvantages, and the best choice for you will depend on your individual circumstances, such as your credit score, income, and long-term plans for the home. It's also crucial to shop around and compare offers from multiple lenders. Even a small difference in interest rate, or APR, can add up to a significant amount over the life of your loan. Choosing the right loan type, being aware of the down payments, understanding the implications of PMI, and knowing the difference between interest rate and APR can save you thousands over the life of your mortgage. Now that we've covered the different types of loans, let's take a moment to understand amortization, a crucial concept in home loans. Amortization is the process of paying off a debt over time through regular payments. A portion of each payment goes towards the loan principal, and the rest goes towards interest. As you make payments, the balance of the loan decreases. Now, let's compare a 7-year, 15-year, and 30-year amortization. A shorter amortization period means higher monthly payments, as you're paying off the loan faster. However, it also means you'll be paying less in interest over the life of the loan. Conversely, a longer amortization period means lower monthly payments, but more interest over the life of the loan. Each of these scenarios has its advantages and disadvantages. A shorter amortization period can save you money over time, but it requires higher monthly payments, which might strain your budget. On the other hand, a longer amortization period means more affordable monthly payments, but you'll end up paying more in interest over the life of the loan. Understanding amortization can help you choose the right loan term for your financial situation. It's a balance between what you can afford to pay each month and how much you're willing to pay in total over the life of your loan. As always, it's essential to consider your personal financial situation and long-term goals when making these decisions. Debt and student loans can greatly impact your ability to secure a mortgage. Let's break this down. When lenders evaluate your loan application, they look at something called your debt-to-income ratio, or DTI. This is essentially a measure of your monthly debt payments divided by your gross monthly income. The higher your DTI, the more risk you pose to lenders. Now, Imagine adding student loans into the mix. These loans can significantly increase your DTI, making it more challenging to get loan approval. If you're carrying a hefty student loan, it's like a weight on your DTI's shoulders, potentially pushing it into a riskier territory for lenders. But don't lose heart. There are strategies to manage your student loans and debt effectively, like consolidating your loans or opting for an income-driven repayment plan. Remember, maintaining a healthy debt-to-income ratio is key to securing your first home loan. Life happens, and sometimes it can throw us curveballs that significantly impact our financial health. Let's delve into how major life events like bankruptcy, divorce, and outstanding medical bills can affect your ability to secure a mortgage. First, bankruptcy. Declaring bankruptcy can severely impact your loan approval chances and credit score. It can stay on your credit report for up to 10 years, making it difficult to qualify for a mortgage. However, some loan programs may allow you to apply for a mortgage after a certain period post-bankruptcy, provided you've demonstrated responsible credit behavior. Next, divorce. Divorce can destabilize your financial situation, affecting both your income and credit. If alimony or child support is a factor, these payments could increase your debt-to-income ratio, affecting your loan eligibility. On the other hand, if you're receiving these payments, they might be considered as part of your income, but lenders usually require a history of regular receipt. Lastly, let's talk about outstanding medical bills. Unpaid medical bills can be sent to collections, which can negatively impact your credit score. Like other debts, these can also increase your debt-to-income ratio, potentially affecting your loan approval chances. Life events can significantly impact your financial health and ability to secure a mortgage. It's important to understand these impacts and plan accordingly. Remember, a knowledgeable financial advisor or mortgage broker can provide valuable guidance during these challenging times. Finally, it's time to close the deal. Having navigated the various stages of the home buying process, we're now at the finish line. But let's not rush. Understanding the closing statement and the associated fees is key to ensuring you're making a sound investment. The closing statement outlines the financial transactions between the buyer and the seller. This includes the home's purchase price, any adjustments for items prepaid by the seller, and credits for any repairs negotiated during the inspection process. Then, there are the closing costs. These are fees paid at the closing of a real estate transaction, and they can vary widely based on location, the property, and the type of loan. Generally, they include origination fees, appraisal fees, title insurance, escrow costs, and prepaid items like homeowners insurance or property taxes. Now, who are the key players in this process? First, there's the real estate agent who guides you through the process and negotiates on your behalf. Then, there's the real estate attorney who ensures all legal documents are properly executed. The property appraiser determines the fair market value of the home, while the insurance agent provides homeowners insurance. Lastly, the title company verifies the legal status of the property, and the originating loan officer and underwriter finalize the mortgage loan. Closing the deal is the final step to home ownership, but it's important to understand all the associated costs. Home ownership is more than just having a place to call your own. It's a stepping stone towards financial freedom and a secure future. Let's delve into the power of home ownership and how it contributes to building generational wealth. Imagine the home you're living in now, not as just a structure of bricks and mortar, but as a financial asset that appreciates over time. That's right. Every mortgage payment you make is like depositing money into a savings account, gradually increasing your home equity. the value of your home that truly belongs to you. As time passes, this equity grows, and so does your wealth. This is not just for you, but also for your future generations. By owning a home, you're setting the foundation for financial security that your children, grandchildren, and even great-grandchildren can benefit from. But the power of home ownership doesn't stop there. Owning a home also opens doors to other financial opportunities. For instance, you can leverage your home equity for loans to start a business, fund education, or even buy another property for investment. In essence, home ownership is a strategic move that provides financial stability, creates opportunities, and builds wealth that lasts. It's a legacy you can pass down through generations, creating a ripple effect of financial empowerment. Remember, the journey to home ownership is not just about finding a perfect home. It's about making a wise investment for your present and future. Home ownership is a powerful tool for building wealth and ensuring a stable future. Let's take a moment to discuss a strategy that can significantly boost your path to building generational wealth. Buying a 2-4 unit multi-family home as a first-time home buyer. This approach to home ownership offers a multitude of benefits. For starters, you can live in one unit and rent out the others, thereby generating income that can help cover your mortgage payments and other expenses. This can make home ownership more affordable and could even turn into a profitable investment. When it comes to mortgages, a 30-year fixed-rate mortgage is a powerful tool for first-time home buyers. It allows you to lock in the interest rate for the entire term of the loan, providing stability and predictability in your payments. This can be particularly advantageous in times of low interest rates, as we're experiencing now. Furthermore, investing in a multi-family home can significantly contribute to building generational wealth. The rental income you earn can be used to pay off the mortgage faster, or can be saved and invested for future growth. Over time, the property's value may appreciate, and you can eventually leverage this equity for other financial opportunities. In conclusion, investing in a multi-family home as your first property can set the foundation for generational wealth. It's a strategy worth considering as you embark on your journey to home ownership. Remember, the path to financial freedom is not just about making money, but also about making smart decisions that can multiply your wealth over time. So, think big, plan well, and make your first home purchase a stepping stone to a secure financial future. That wraps up our guide to buying your first home. We've journeyed through the essential steps, from understanding what documentation is needed to grasping the complexities of the underwriting process. We've explored the impact of debt and student loans on your mortgage application and navigated the world of loan types, including conventional, jumbo, and government-backed options. We've also delved into the significance of the loan-to-value ratio, the importance of a good FICO score, and the role of primary mortgage insurance. We've highlighted the types of properties that qualify for first-time buyer programs and the difference between interest rates and APR. Finally, we've discussed the closing statement, all the expected fees, and the key relationships you'll form along the way. Remember, owning a home is more than just a purchase. It's an investment in your future and a stepping stone to generational wealth. Thank you for joining us today. Remember, if you found this information helpful, please subscribe to the channel, leave a comment, and hit the like button.